What's next for markets? Hello, I'm Stephen Gregory. I'm filling in this week for Michael Kantorowicz. I'm joined here today by Emily Needell, who is the Deputy Chief Investment Strategist at Piper Sandler. Hello, Emily. How are you doing today?
Hello, doing wonderful. It's good to be here.
I'm super excited to talk about this topic. We're going to delve into the world of quality today. It's something we've been talking about a lot recently on the show, and it's been a theme over the last couple of years, but it's also a really generic term that means a lot of different things to a lot of different people. So maybe a good place to start is, how do we define quality? What is quality?
Yeah, that is actually a fantastic question. And we often hear clients and investors refer to quality in so many different ways. We typically think about stocks that have quality fundamentals as being those that are strong and resilient in terms of their attributes. So we like to focus on things, we consider quality stocks to be those that have high profitability. So things like a high ROE, ROA. We like to look at stocks that have high coverage ratios. We like to look at stocks that have free cash flow yield. And so looking at profitability, coverage ratios, free cash flow yield, stocks that have those traits in abundance are more resilient. They tend to do well sort of regardless of what the macro backdrop is. And so to us, that is the definition of quality, are stocks that can continue to do well and to grow and to be strong and profitable regardless of the economic backdrop.
Yeah, so over the last couple of years, when we've been in an interest rate environment that's higher, having a good coverage ratio, being able to generate capital in excess of what your interest expense are, very important attribute to have. And also, we've been in a strong economic backdrop, but it's been a bifurcated one. Not every company has been participating at the same level. So profitability has been a little bit more scarce. So these strong fundamentals have really been great drivers of return. And it's that scarcity that's been bidding them up. Now, what are some of the things that you hear people talking about when they talk about quality that maybe doesn't match up exactly with what we are talking about when we're talking about quality?
Yeah. So people often think about factors like low leverage and high dividend yield as being quality factors. And those are just two examples of factors that people put under the quality umbrella that we have some issues with. Low leverage, for example, I mean, in theory, stocks that aren't highly levered, that could be an attractive trade and a higher quality trade. However, many of those low leverage companies have lower leverage because they don't have the same access to capital as some of their higher quality, let's call it, peers. So oftentimes, if you are a stock that or a company that is unable to get credit, or you have to pay a higher rate on that credit, that is not something that would, that could drive you to be lower leverage, but isn't necessarily a good thing for you. And actually, the Bloomberg quality factor has low leverage in it. So if you go to FTW in Bloomberg, there is a quality factor in there that is one of the worst performing factors of the last decade. And so this is just an interesting example because we know from all the work that we do on factors, and we spend a lot of time on factors, that quality factors have done exceptionally well over the last decade. And yet Bloomberg in their FTW quality factor has it as being one of the worst factors of the last decade, down there with the most shorted as, the two of the worst factors over the last decade. And a big part of their issue is they have low leverage as one of the factors within that quality umbrella. So again, stocks that have low leverage often are so because they have to be lower leverage because they don't have that access to capital. And then another one, dividend yield. So people often think about dividend yield as being a buffer. Stocks that pay a high dividend, if things are slowing, if the market gets hit, you have that dividend buffer. But one of the reasons that we do not think about high dividend yield as being a high quality factor inherently is that, one, dividend yield it's a value factor. It's dividend over price. So value factors tend to be more cyclically sensitive than other factors. And so they do tend to be, moved around by the cycle. And so they are not as insulated from the macro backdrop as some of the other quality factors that we like to focus on. And then also dividend can get cut, and they do get cut. And so dividends tend to be sensitive to economic growth. And so if you're in a backdrop where growth is slowing significantly, you're likely to see dividend cuts. And so they're not insulated from the economic backdrop. And so high dividend yield, again, it tends to be one of the more cyclical factors. And so we would not put it under the quality umbrella. Certainly you can find stocks that have high dividend yield that are high quality, but inherently we wouldn't think of high dividend yield or low leverage as on their own just factors that are quality.
That's pretty surprising when you mentioned about Bloomberg's kind of quality composite factor and how it's been one of the worst.
It's shocking. When we've been talking about quality for years and people started asking, you're talking about quality, but yet I'm seeing on Bloomberg that it's doing so poorly. And so we really dug into it, to discover that the reason why it's doing so poorly is because the quality, quote unquote, factors that are in it are just not actually what we would define as quality factors.
That's amazing. I think most investors would universally agree over the last couple of years, you wanted to be in quality. So to pull up the FTW screen and see that it's lagging has got to be a bit of a head scratcher for most. Definitely doesn't make a ton of sense there. So all these things that you're talking about are what most, I think, people buying stocks, whether you're a individual investor or a retail investor, would be like, yeah, of course I want to own companies making money. Of course I don't want them to be levered so much that they can't necessarily cover their interest expense, i.e. the coverage ratios. So don't I always want these?
That is a great question. And certainly high quality stocks do outperform more often over the long term. There are some parts of the business cycle where you could do better than being in the quality names in terms of performance. So, for example, very early in a recovery, let's call it. Let's say for prime example, coming out of a recession, right? So usually coming out of a recession or throughout the recession, the market gets hit, and then at some point you see recovery in the market, and that's when you tend to see those junk rallies that we call it, where high beta is really ripping and the most shorted stocks are getting squeezed higher. And so in those backdrops, quality tends to lag. Quality stocks still generally are going up. They still increase in price because pretty much everything does in those backdrops, but they tend to lag. So in that type of backdrop, you could be better off being in more cyclical stocks than in quality. So that is one example of where quality tends to lag. Also, if you are in a market sell-off or you're going into recession, quality stocks should outperform, but they may not be the best factor. So for example, if you're in the middle of a correction or a recession and you're seeing the market selling off hard, defensive attributes like low beta, low vol, those tend to be the best performing types of factors. Whereas these quality factors that I mentioned, profitability, free cash flow yield, they should probably also be outperforming, but not as well as those more defensive traits. So really, I think the conclusion from that is that quality factors tend to do well throughout most of a market cycle, except very early in the cycle when you're seeing those, sort of low quality rallies, or very late in the cycle where defense is outperforming. But over the long haul, if you stick with these quality factors for buy and hold investors, for example, stocks that have these quality attributes do generally outperform throughout the majority of the cycle. And when we have over 120 factors that we track over time. And the quality factors that I mentioned, those profitability, free cash flow yield, coverage, those are the best performing factors over time in terms of magnitude and frequency of outperforming. So they do tend to outperform more frequently than any of the other factors that we track.
So that's interesting. One of the kind of pushbacks you often hear around the idea of quality investing, it's kind of a cop-out. It's you don't know what to recommend, you recommend quality. But as you just described, there is a time and a place for it. It is a distinct quadrant of the market cycle. Now, that then begs the question of, we've done work on this, and it's not just us. You can see in academia, a typical market cycle is somewhere between 4 to 5 years, depending on how you measure it. Why have we been in a quality backdrop for now 3 years? Maybe you could even argue maybe it's a little more than that.
That's a great question. So a big part of why we've seen quality outperform consistently for such a long period of time over the last couple of years has been that we've been in what I would call a sort of a range-bound backdrop for the overall economy. So we've seen rates that have been higher for longer. We haven't really seen any significant acceleration or deceleration in overall economic growth. So, when we look at things like PMIs, which is, a leading indicator of the economy, you see they're either rising or falling. They tend to be kind of range bound for short periods of time. We've seen that range bound period be for several years. And The fact that we've seen rates higher for longer and we haven't been able to see any big pickup in housing activity has all created an environment where we've been kind of stuck. We haven't seen any, again, major broad-based acceleration or deceleration. And so in that backdrop, we've been seeing bifurcation because there are winners and losers of this backdrop. So there are companies that are best able to navigate a backdrop of higher rates, and then there are the stocks that are really suffering in this environment. And so given that bifurcation, we're seeing investors gravitate towards quality, towards, the types of stocks that are best able to navigate a backdrop where you do have sort of uncomfortably high rates. And so we've been in this backdrop for years. We've seen rates be higher for longer now for several years. And as long as we continue to be in a backdrop where rates are uncomfortably high, we're likely to continue to see bifurcation, and we're likely to continue to see investors reach for quality.
I don't know about you, but I'm anxiously awaiting being able to make a call that isn't quality.
Oh, I would love to. I'm so ready. I feel like, we've been talking about quality ad nauseum, but it has been, it's been the name of the game, and it's likely to continue to be until we're able to get, a significant decline in rates that will be enough to stimulate the economy. And, we look towards housing as sort of the area of the economy most sensitive that tends to react first. And so we're watching housing activity very closely, every time we get any type of decline in rates to see if we're getting any pickup yet. And we just, we haven't seen that. We haven't seen that happen yet.
So, until we break out of this range bound trend that you're talking about, get slightly above trend growth or slightly below trend growth and get a direction, then you can get a leadership change. Mentioning that though, I would be remiss if I did not talk about my favorite chart in the world, the PMI composite chart, and, how that has basically been sideways for 3 years. The PMI chart, especially the manufacturing one, goes back to 1948, and it's just up, down, up, down. It's the earnings cycle. You're accelerating above trend, you're accelerating below trend, and it's just been sideways for a little over 3 years now. Without knowing anything else, you'd look at that chart and be like, you probably wanted to own companies that had that macro moat, that were seeing above average profitability and returns.
That is an amazing chart of the average of the ISM manufacturing and ISM services composites. And it's stunning how typically you see it's either rising or it's falling. There's clear trends. And we've just been flatlined for years now, right around the 50 threshold, which is the differentiator between expansion and contraction. And so, again, we just haven't seen any real broad-based reacceleration or deceleration across those composites.
So one last thing I want to ask you, because it's another pushback on this idea of quality. Aren't you just talking about the Mag 7? Aren't you just talking about TMT, which does get a little conflated sometimes in with this quality trade? Why is that? And how do you address that?
Yes, that is a big question. And no, I'm not just talking about the Mag 7 or TMT. Certainly, many of the Mag 7 names exhibit quality attributes, but what we're talking about goes well beyond just TMT. I mean, you can find quality in every sector, and we do chart. We talk about those factors, those quality factors: ROE, ROA, free cash flow yield. And if we look at those charts within every sector, they have very similar performance. They've been up and to the right. The relative performance of the stocks that have the high quality attributes versus the low quality attributes, there's significant outperformance across the sectors. And we can even go further to say that if you look across the index, let's say you look at the S&P 500 or the 1500, and you pull the stocks that have the highest profitability across every sector. Let's say you take the top decile, the top 10% of stocks in each sector, put them all together. That basket of stocks will have higher profitability than any individual sector, even technology, which is the highest profitability sector. So what we're doing, when we do our analysis in terms of factor performance, and when we talk about quality, we're talking about this broadly across the market. And there certainly are stocks in, like I said, in many regions that have these quality attributes, and you can find outperformance of quality in every sector. So certainly, again, Mag 7, there are certainly some of the most, some of the highest quality stocks out there, but it is not at all just a Mag 7 story. This, quality leadership works in small caps and mid caps, in just about every corner of the market.
So Emily, it's really about just identifying those kind of attributes that are quality, those profitability ratios, those coverage ratios, and free cash flow on the stock level. It's not about a sector or a sector group or these 7 stocks. Those are what investors should be looking for until we see a change in the macro landscape. Well, thanks for going through all that today. That is definitely helpful context for something, we've been talking about a lot in the show.
Absolutely. Thank you.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.